us all the way from Thailand. Mark Faber, the unmatched investment guru, joins us. Mr. Faber, good evening to you. Thank you very much for joining us all the way from Thailand. Well, first up, do you think the markets should show more signs of worry over the American elections? Do you think closer to November 8th, we could see a lot more jitters?
Well, I think that the belief is that obviously Trump victory, if he got elected, would be negative for asset markets, for the U.S. market, and that a Hillary victory would be positive. But I'm not so sure about this belief, for the simple reason that Hillary is basically a neocon and is a warmonger and has invaded or supported the invasion of a variety of countries already. So that may lead to more international tensions, whereas Trump is more aware of the fact that the U.S. superpower standing is gradually waning, and that other countries are coming up, and that the U.S. cannot fight the whole world and cannot be the policeman to the whole world, and that they have to gradually start to negotiate with other countries on equal terms.
Okay, Mr. Faber, good afternoon from India. So, is it like a lose-lose situation? I mean, half the people don't want Trump to come on board, and now you're saying, if Hillary comes on board as well, there'll be a lot of international tension. Are we looking at the possibility of a big crack in global markets post the elections?
I don't think it will happen before the election, because the Fed shivers at the thought of a Trump victory. They are supporting Hillary Clinton, as incidentally the entire media establishment is supporting Hillary Clinton and is anti-Trump, is very biased against Trump. Now, my view is that in this environment, and we have now clear voices at the Fed and other central banks, that basically the Fed should be able to implement negative interest rates, and B, that the Fed and other central banks might do well if they bought equities. So under this scenario, you ask yourself, what is actually the downside risk? In my view, under both Trump and Hillary, they will continue to print money. There is no other way out. The system is basically bankrupt, and so money printing will continue. And then the question is, what will happen to asset markets? In theory, they can continue to go up. As I pointed out, I'm not optimistic about the global economy, but if you print enough money, say the central bank's balance sheets increased between 98 and 2015 by 16 times, 1/6 times.
Okay.
Why can't they go up another 10, 20 times in the next 5 years? And in that scenario, the Indian market can go up, the Dow Jones could go to 100,000, and so forth and so on. Anything is possible. We don't know how far the mad professors at central banks will go.
No, I take your point. A lot of experts, including yourself, have been, speaking out against the central bank policies. But separately, over the next quarter or 2 quarters, what do you see as red flags for the market? Could it be the European banking system, for instance?
Yes, this is a concern. European banks are in a very poor financial condition. They will need more capital. But you understand, in theory, the ECB and other central banks can essentially provide liquidity to the established banks. And governments, if they like, they can basically bail out banks. They may have bail-ins here and there, where some bondholders, like there are cocoa bonds outstanding, would get hurt to some extent. But basically, the governments can essentially buy shares in, say, Commerzbank or Deutsche Bank and recapitalize the bank as a result of that. And then the government will be an owner of, say, 50% of the bank or 30% or whatnot. That is all possible. We just don't know. We are, and I'm writing a report about this, in a surrealistic economic and financial world.
Okay.
So, I read in a report that you had written, or rather in an interview that you had given, that over a 10-year period, you prefer investing in the Indian markets rather than the US markets. So what makes you so confident about India?
Well, I know that there are studies that will negate this view, but in my opinion, a country that grows at, say, 5 or 6 or 7%, such as India, will have, in the long run, corporate profit growth that is about equal to GDP, and if companies are well run, and if they can expand for a given period of time as a percentage of the economy, they can achieve earnings growth of, say, 10, 15, 20% per annum for a given period of time. So in other words, nominal economic growth translates into higher corporate profits, and that in the long run translates into higher equity prices.
Okay.
And that is the case for India.
Okay.
In the case of the US, we've had an expansion now for more than 7 years. It began in 2009 in June. We're now already October 2016. So by historical standards, the expansion is very old. Corporate profits have started to decline. The economy is hardly growing. I don't see where corporate profits will grow substantially in the U.S. So my view is, if I look at the next 5 to 10 years, I think that emerging economies, stock markets, in particular the Indian economy, which can easily grow at 5 to 7% per annum for the next 10 years, that they will perform better than the U.S. There is one proviso, however, and this is the most important condition for financial markets to do well, and that is peace. And I'm afraid that there are so many Republicans and neocons of the Republican Party that support Hillary that a deal between Hillary Clinton and the neocons was already done, that the neocons will basically take over foreign policy, and Hillary Clinton can print money in the U.S. and distribute money to minorities and God knows what, and that this deal can lead to international tensions that then are not conducive to equities and bond prices.
Okay. Mr. Faber, what would you be buying now if your clients asked you to invest their money?
Well, that is a very good question. I think I would tell my clients we have had an incredible bond market rally since 1981. Bond yields are not going to go down much more. They may not go up substantially, but they're not going to go to minus 5% per annum. So the bond market is relatively unattractive. Does it mean that equities are much more attractive? That is far from certain, because if yields on, say, the U.S. 10-year Treasury goes to 2.5% or 3%, that may hit actually equity markets as well. So I would tell the client, look, I'm happy to invest your money, but the returns over the next 5 years or 10 years will be very disappointing to you, because you expect to make between 8 and 12% on your portfolio every year. And that is simply not going to happen.
Okay, so would we have to endure a big crash in global equities, say, over the next 6 to 12 months? Is that something that you're forecasting?
It's not necessarily a forecast, but I think it could easily happen. The U.S. market is so much more expensive based on price to sales, price to earnings, price to book than any other market in the world that U.S. stocks are, in my opinion, more vulnerable than is in general perceived. So they could easily... We were in February of this year at 1810 on the S&P. Okay, 1810 from here would be a decline of more than 10%. But if the market goes to 1810, we could go down also 20% or even 40%. But I believe as we would approach the February lows on the S&P at 1810, that the Fed, under the influence of the money printers and people like Larry Summers, who advocates and recommends the Fed to buy equities, that the Fed and other central banks would step in and start to buy equities to support the market.
Yes, well, that also exists. Well, are you buying gold, anything other than paper assets?
Yes, you see, I'm spending a lot of time thinking the current financial system, that we can all agree is not sustainable in the long run. The big question is, how will it all unwind? Will it unwind with a breakdown of democracy, with a breakdown of law and order, and so forth and so on? We just don't know. But I think one of the potential significant problems that may occur is what the Fed and other central banks actually wish for, and this is inflation. I think there's a good chance that commodity prices have bottomed out and that inflation in general will accelerate. In other words, people's cost of living will start to go up more than what is desirable. And that will depress real earnings, but it will be good for assets such as commodities, especially precious metals, obviously, and very negative for bonds and probably negative for equities when yields go up. So I want to own some commodities. I think if you look at sectors in the U.S. or globally, what is inexpensive? Okay, gold shares have rallied, say, 100% from the lows. But they came down before by 90%, so they're still relatively inexpensive. You look at basic stocks that are producing copper or aluminum and so forth and so on. These companies are not terribly expensive from a long-term cyclical point of view. So there I see some value.
Okay.
And that is where I would put some of my clients' money. Now, if you come with $1 million to me, I'm not going to buy and put it all in gold and gold shares. You understand? That would be irresponsible. But I would tell you, maybe you should have at least 25 to 30% of your money in an asset that cannot be printed by central banks.
Okay.
Okay, we got that.
Got that.
We got that fear. But, you know, before we let you go, you've confused us a little bit more about the US elections and who one should vote for. I know you can't vote because you're sitting in Thailand, but if you could, who would you vote for?
Of course, I would never, and I repeat, never in my life would I vote for someone like Hillary Clinton or Bill Clinton.
Okay.
They are dishonest, have no morals whatsoever, and there's so much smoke around them wherever they went, wherever they lived, that when there is so much smoke, there must be also a big fire somewhere.
Okay.
Okay, that fear is
We
very
got
well
your
taken.
vote.
Yeah.
We got your vote by default, Mr. Mark Faber. Thank you very much for
It's
joining
my
us.
pleasure.
All right. So no